What's going on, everyone? It is January 18th, 2021. So what we're going to look at is Netflix, which is due to report earnings tomorrow, January 19th, 2021, after hours. And what are potential ways to be playing Netflix for earnings? So the first option, plain and simple, would be not to play it at all. You know, there's always just the outsized chance that things are going to move tremendously against you, and there would be considerable risk. But if you feel like you need to have your hands in the cookie jar, you want to be able to get a piece of the action, you need to play it. It's always there. And these are some potential options. Now, let's take a look, though, first going back on the monthly chart of Netflix. Looking back here, this is 10 years. And it's amazing to see that, you know, back in August of 2012, Netflix was trading as low as $7.50. Now, what you can see here is that as the years have gone on, what has happened is that there have been some specific breakout points. So back in 2018, you saw there was a really strong breakout. You saw a strong move higher, and then a consolidation of that strong move higher. Now, let's take a look at here. That high back then in June of 2018 was $423.21 right here. What you could see then was for over a year, there was just digestion and consolidation, sideways movement of this, acceptance of this higher price, until you could see here in October, what kicked off was an amazing run going for several months of just nonstop bullishness of Netflix, taking out that prior high of 423, and then now a secondary phase of consolidation. So what you could see here is that back then, move higher, sideways. What we have right now is a move higher and sideways. So this looks healthy. This looks as if Netflix is showing acceptance of these higher prices. And with a longer term, what it may be showing is that there could be another move, potentially higher itself. Now, this is important to look at because what we'll look at is here this prior breakout point of just about 425 and the current all-time highs of 575 as potential options. If we take a look more granular, looking back here on the daily, what you could see is that going back to July of last year, Netflix has really been just going sideways in range. This range has shown a low of about 460 and a high of 575. So it's just about $100 range, and it's just been going sideways. This has been great for anyone who's been collecting premium, but if anyone's been out there who's been purchasing calls or puts, you're just getting burned unless you're doing something really short term, just trying to catch a move and then get out right away, because everything's just been reverting here back to this point. So let's take a look back at earnings here for the past year for Netflix. You could see that overall the movement was about 3.5% to 8% approximately. And what this chart shows is that what was the price just before and what was the price the day after. So for example, you could see here that some of these moves, they were not really that significant. So what that means is that it presents opportunity for a potential earnings play, because what happens is you have a pumped up IV that makes options be much more expensive than they should be. Now let's take a look here on the chain itself for Netflix. And what you could see is that the expected move from the market makers and Thinkorswim is showing about $33.72. Now, I feel a more accurate way to look at it is to look at the at-the-money straddle. And what you could see here, if let's say this is just before the close on Tuesday, January 19th, 2021, and that's always when you want to be looking at, just before the close if you're looking to be making a play on earnings, because IV can get pumped up right into the close itself. And if you try to make a move too early in the day, or in advance, what oftentimes can happen is that this can go against you. So especially if you're selling premium and then you have a spike in the IV, then what's going to happen is that you're actually going to have the options being more expensive and you're immediately going to be underwater. So always you want to wait for just before the bell is going to ring to be putting on a play like this. So let's say you want to sell, though, and at the money straddle. So this is one option. And this is telling you here that the expected move, if this were right before the close tomorrow afternoon, would be about $40 approximately. And what you would say is that, okay, if you sell this, this is going to require quite a bit of margin because you're selling a naked call and a put. What you're really looking to see is that the move itself in earnings is going to be less than $40. Because let's say Netflix just opens up the following day, even though it has a great earnings, and it opens up at 500 again. What it's going to mean is that all of the IV is going to get crushed in these options. And this $40 credit that you've received, you could purchase back these two options, let's say for potentially $33, $34 very easily and right away. And that would easily net you, a few dollars in profit. It's always also important if you're going to be making moves like this is to not get greedy. Don't think you're going to collect all $40 in credit. If you're going to have a decent profit, go ahead, take it off, lock it in, and then move on to the next. So let's say you don't have the capital to be able to do a naked straddle. So what else could you do? So what you could do is you could sell an iron fly. So an iron fly is a variant of an iron condor in that you're selling the 497.50 call and put, but then you're going to cap this on the upper end and the lower end. And what I would say is that it's probably worth capping, let's say right at 575, which we know is its prior all-time high, and then the breakout point that we had listed of 425. So if we do that, you could see that that is going to net you $36.38 of credit. So as long as the move in Netflix is going to be less than, let's say, $36, which this is close to what the At the Money straddle was marking, then again, you could just buy this back for a potential couple of dollars of profit, especially if there ends up being IV crush with Netflix not moving at all after earnings. So that's there as a potential option too. Another option could be that you wanted to sell an iron condor. Obviously, this is one that people may be looking at as more of an entry level just to get their feet wet. So what you could do here is you could sell the 575 call, which we're again looking at as being the prior all-time highs. And let's pull this up on the monthly again. And then here we have 425 as the prior breakout point on the put side. So let's say you sold the 575 call. You purchased $5 wide, you could say the 580. You could sell the 425 put, and $5 below that, the 420 put you could purchase. And you could see this, the iron condor, and what the iron condor means is that as long as Netflix is between 425 and 575, these options are going to expire worthless and you would collect this credit. But you could see here you're only collecting 41 cents of credit for a risk of $4.60. So really you're risking 10 times what you would potentially receive, and that's really not necessarily a good risk profile. If you tried to make this a bit wider, so let's say you go $10 wide, 475, 585 on the call side, and 425, 415 on the put side, you could see you're getting a little bit more credit, but you're increasing your risk because you've doubled the width of your spread itself. So that's there. It could be less margin intensive if you just feel you want to get a piece of the action and you want to see, how things are going to play out, but you don't feel that Netflix is going to go to a new all-time high or it's going to break below the prior breakout point. Another option could be if you have a bullish or a bearish idea about Netflix going into earnings would be to look at a ratio spread. Now, again, this is going to require more margin, but what you could look at is a ratio spread, which entails purchasing one option, let's say you're bullish, and selling two calls above that, okay? So let's say you're looking at the prior breakout point of 575 as being resistance. So here what you would be looking at is selling the 575 calls, and you would do that 2 times, and you could purchase, for example, the 560 call, and what this would net you is actually a credit. So you're being paid to put on this trade. So let's say Netflix goes sideways into the end of the week, then this credit is yours to keep. Let's say Netflix does horrible and it's going to go lower, okay? Then that's fine. You're still going to make out okay because this 74 cents credit is yours. Let's say Netflix moves slightly up. It's possible this could actually expand and you may be able to take this off for another credit and actually make money twice on this. So that's a potential option as well. Really, the big way that you're going to get into trouble with this is that if Netflix moves fast and highly, So let's say it gaps up into, let's say, 570 the next day. Then you're going to be underwater because you're short 2 strikes here. But there are ways that you could potentially defend that. But really, this gives you, a decent amount of flexibility. Let's say you're overall bullish on Netflix. Let's say you're not, you're bearish on Netflix. Then you could be looking at potentially getting the ratio of a 425, 420. So here again, what you're going to be doing is you're going to be collecting credit, 66 cents, which offers you a window of opportunity to the downside should it go lower. And you would feel that, okay, that resistance point, we're not going to go below the prior breakout of 425. Or if it blows out earnings and it goes completely higher, you're going to be all right because this credit is going to be yours to receive. So these are some potential options that you could be looking at with respect to options. Now, another way to do this is the day after. And you could set your chart to either have a 1 minute, 5 minute, and or a 15-minute chart. And what you could be looking to do is looking to see the following day at the open and looking at this with shares to see if you want to buy or sell above or below that first 15-minute bar. And I usually prefer the 15-minute bar because what that does is it allows there to be an option for things to digest. If you were to be looking at a 1 minute or a 5 minute, then things are going to be moving very quickly and you really got to be quick on the ball. But 15 minutes, I feel, gives an opportunity for things to really just consolidate ever so slightly after the earnings. And then let's say this is the opening day. Okay, this is your first candle. And what you have here is a high of 499 and a low of 497. So if the next candle starts to go below 497, then you sell or you short the stock, and then you monitor for continuation. If you end up coming back into the range, then you say, okay, that's it. It was too early. Then you close out the trade. Let's say it breaks above 499. Then that's when you buy shares and you monitor for continuation and then look for a quick exit. So these are ways that people could scalp if they want to get into that. And that's another option there. So hopefully this is helpful. Good luck out there. Be safe. And remember, none of this is financial advice.